Well, let's get to our next guest. How to go and play these tricky markets, because they are just that tricky. Do that. Sean Fenton from Sage Capital. He's the Chief Investment Officer and he's standing by. Sean, welcome back to the program. Fantastic to go and see you there. It is very difficult out there. How would you go about playing at this point in time?
Yeah, no, as you say, it's a very tricky market. Probably because it's a very macro-driven market as well. So whilst there's a lot of things happening with different companies, everything's really being overwhelmed by what we're seeing around the world in terms of inflation and responses by central banks to try and get that under control. So they're obviously ranging from what the US Federal Reserve's doing and has done during the week in terms of, and the Bank of England last night as well, in terms of hiking interest rates, attempting to cool the economy, slow inflation, back to what Japan's doing, which is sitting on its hands and hoping it all goes away. But that's created a very challenging backdrop for investors, where bond yields are inexorably grinding higher, pressuring valuations, and we're really looking down the barrel of a recession as central banks try and get that under control. So big impacts on earnings.
Clearly, it's having a lot of impact when it comes to market volatility at the moment, also depressing valuations. As a longer-term investor, as you are there at Sage, what is this actually a good thing? It actually goes and brings out value and unlocks value for longer-term investors?
Yeah, it certainly can do, and sometimes the baby gets thrown out with the bathwater. But there's always, as I said earlier, there's opportunities across the market. So at Sage we do try and strip out a lot of that macro noise and look at some of the dynamics occurring within the market. So there's always various winners through any market environment. So we're looking for those areas of safety and outperformance. So for instance, within the financial space, there are obviously companies actually benefit from higher interest rates. So things like the insurance companies, so across QBE, IAG, Suncorp, they've all got large books of policyholders' funds and shareholders' capital as well, where they're actually earning higher interest rates. Running yields are improving as bond yields move higher, and because we're in a reasonably inflationary environment, they're getting good growth in terms of premium increases and book growth as well, which is helping them. So there's those sort of opportunities. You mentioned Allchem earlier on is doing well. So even within resources, where China's looking a little bit wobbly, Xi's looking like he wants a bit more common prosperity and isn't really coming to the party in terms of unlocking COVID zero or doing property stimulus, and iron ore's under pressure. On the flip side of the coin, you've got this massive transition from fossil fuels to electric vehicles, driving what looks like a decade plus long boom in demand for lithium. So lithium companies continue to do very well in that broader resources space. So there are opportunities to be both long and short within the market, even if the overall backdrop's quite negative.
Where are some of the areas that you're a bit coy on at the moment, cautious about where to be too overweight at this point in time? There's a lot of nervousness out there. You mentioned what's going on with China. We've seen the iron ore miners come off quite aggressively on the back of that as well. What are some of the areas that you're a little bit cautious on here and now? Yeah,
so other than iron ore, I think it's a very tough part of the market, because we can see what's coming down the pipe in terms of rate tightening, what that's going to do to the economic cycle, and a lot of the retail sector has been doing very, very well through COVID, big spending there. We don't actually see that falling off in the short term. Even though interest rates are going up, households have got a lot of buffers in terms of excess savings they're tapping into, and importantly, employment's very strong, and wages growth solid as well. So whilst there's cost of living pressures, we actually see the retail environment holding up through Christmas, and probably a little bit too early to get negative there. But the real pointy end of interest rate rises is the housing market and asset values. So that's really taking the brunt, both in the US and Australia, in terms of both house prices and new housing starts. So that's the area of the weakness that we see coming through most quickly. So companies, building related stocks. So CSR reported this morning, very strong result, doing well, but it opened up very strongly and faded away as people are looking forward, looking to that weakness. A lot of them impacted by wet weather as well. So Boral's really been struggling there, and other broader housing related exposures, things like REA, which has been doing fantastically in terms of housing listings and good depth penetration and price growth there, but starting to face a real softening in the listing cycles for property as that market starts to stagnate as prices fall. So there's some areas of weakness emerging there already.
Sean, just back on the banks in particular, we've got this push and pull factors. Net interest margins are expected to go and expand, given what we're seeing from the RBA and the like, and the lag when it comes to deposit rates being passed through to customers. But at the same time, bad debts, provisioning is always a risk when you're talking about high interest rates and the like, and potential that we might then see a pickup in unemployment. How do you see that screen when it comes to looking at the banks at the moment?
Yeah, look, I think you summarised it pretty well there. And as with markets, it's always challenging to look how far forward are you looking. The very short term for the banks looks fantastic, as you say. They're putting up interest rates much faster than deposit rates, so their lending rates are going up, expanding net interest margins, and you're seeing that through all the banks as they're doing quarterly and half-yearly reporting, that net interest margins really expanding quite aggressively. But that picture does start to change as we continue to roll forward. Term funding facility from the RBA starts to roll off, so we expect to see deposit competition increasing. You're already starting to see term deposit rates move up. You can see more competition from things like annuities from Challenger, and importantly, as we go through that period of the fixed rate surge from 2 years ago rolling off, we're likely to see mortgage competition really pick up in intensity. So we think we're at peak sort of net interest margin benefits over the next quarter or two, and then the outlook starts to get a little bit more clouded because banks tend to have very left-sided tail risk in terms of credit, and we do start going to a deteriorating credit environment. So whilst I'm not forecasting Armageddon, obviously house prices are falling, so losses on default go up, and importantly risk-weighted assets start going up as loan to valuation ratios move up, so capital intensity moves up from the bank, so all their capital requirements start becoming pro-cyclical. So as we move through the middle and into the later part of next year, that environment starts deteriorating. So we're getting closer to a point where the good news is priced in for the banks, and it's probably looking like we're getting close to the time to start taking profits and even going short through early next year.
Super quick one to go finish off. Over there at Sage, do you have a mandate to be fully invested at all times, or do you have the ability to go and sit on cash levels? And if so, what are they at the moment?
So we run two different funds. One's market neutral, which is always just basically no exposure to the market, and one which is an equity fund, which always has full exposure. So we actually keep our cash levels quite tight in both of them. So we're always fully invested in our equity fund, but we run a long-short structure, which gives us great flexibility in terms of utilising that relative performance between companies to add value beyond the market. So within that mix, we're a little bit more defensive in terms of looking for companies that have strong balance sheets, more defensible earnings in terms of their exposure to cyclicality and those things. So we're not holding cash, but we're thinking about the world from a defensive point of view.